Have you ever been wondering which asset groups are worth your investment in 2025 and which ones you should avoid? You are in the right place. Today we will discuss two asset groups you should invest and two you should avoid in 2025. I'll break it down step by step using real world insights to help you make smarter investment decisions. Let's dive into it. If you are new to my channel, my name is Oberoi and I'm a real estate agent, investor, and a serial entrepreneur. I went from working as a server to owning multi-million-dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. My top pick for this year is, no surprise, since I sell many of these, it's commercial plazas and strip malls. These properties provide steady, reliable income and remain resilient in different economic conditions. Think about plazas anchored by essential services like grocery stores, pharmacies, doctors, and coffee shops, because people visit this regularly no matter what the economy is like. Strip malls cater to community needs and benefit from consistent foot traffic, making them a safer bet. Commercial plazas and strip malls are an excellent choice because they attract a stable tenant base. Essential services like grocery stores and pharmacies are highly resilient, thriving even during economic downturns. Guys, these properties' strategic locations ensure they meet community needs, leading to consistent foot traffic that helps tenants succeed. Unlike other real estate asset types, commercial plazas and strip malls tend to be less affected by economic cycles. Moreover, a diverse mix of tenants in these properties minimize risk associated with tenants' turnover. When looking for these properties, prioritize well-located options with a balanced tenant mix to ensure long-term stability and returns. Another strong contender for 2025 is multi-family housing. Rental demand in British Columbia, particularly in Vancouver, remains incredibly high, with vacancy rates under 1%. As interest rates drop, financing multi-family properties will become more affordable, further boosting their appeal. These assets are excellent for consistent cash flow and long-term appreciation. Multi-family housing provides several advantages. Urban centers and growing communities with low vacancy rate ensure stable and predictable rental income. These properties are a reliable source of cash flow, allowing investors to plan their finances with greater confidence. Additionally, multi-family housing will appreciate over time, especially in areas experiencing economic and population growth. With interest rates expected to decrease, financing these properties become even more accessible, making them a high attractive investment option. Now let's talk about two asset groups to avoid in 2025. First one is development projects. They are one of the riskiest investments in 2025. High construction costs, delays, and uncertain timelines make this asset group challenging not only for you, but for most experienced and well-resourced investors. Many well-known developers are even facing challenges, with some going out of business, while others are scaling back operations and exercising extreme caution. The risks associated with the development projects are considerably high. Reasons: upfront costs driven by rising material and labor expenses and significantly reducing the profit margin. Additionally, lengthy approval process create delays that can deteriorate your project timelines. Market volatility adds another layer of uncertainty, with economic shifts potentially affecting the feasibility and profitability of development projects. Unless you have the resource and expertise to navigate these developments, it's best to stay clear of this asset group in 2025. The second asset group to avoid is large office spaces. The sector is facing significant challenges as companies increasingly adopt remote and hybrid work models, reducing the demand for office space. Older office buildings in particular are struggling to attract tenants and often experience high vacancy rates. Even traditionally strong markets like ours in Vancouver are seeing this struggle. Investing in large office spaces comes with substantial risk. The declining demand of office space, driven by challenging workplace norms, and has made it difficult to lease out these properties, guys. High vacancy rates mean prolonged periods without rental income, which will impact your cash flow. Reselling these properties can also be challenging as buyers are also seeing these trends in office spaces. Key takeaways for 2025. Focus on property with a stable cash flow, high demand, and clear long-term value. Commercial plaza, strip malls, and multifamily housing fit those criteria. These asset groups offer steady income and the potential for appreciation. On the other hand, risky investments like development projects and large office spaces should be avoided given the challenges they present. By aligning your strategy with the market trends, you will position yourself for success in the year ahead. If you find this video helpful, don't forget to hit that like button, subscribe, and share it with someone who might be benefit from this information. And as always, leave your questions in the comments below. See you next time.